Kia ora koutou katoa. As you mentioned, Andrew, my name's John. I'm one of the directors of the CFA Society. Similar to earlier sessions we've had today, this session is no different. It has quite an impactful title, Brace for Impact, Finance's Evolution from Profit to Purchase. This session is about impact investing. So what is impact investing? What are examples of impact investments made in New Zealand? And how can we measure the impact of those investments? Just to get a raise of hands in terms of an understanding of where the audience is at on this topic today, can I ask that you raise your hands if you've heard of the term impact investing before? Can you keep your hand up if you could point to a few impact investments that have been made in the New Zealand market? And keep your hand up still if you feel like you could measure the impact of some of those investments that were made. There's probably, most hands are down now. I'd like to introduce our panellists today. Barry Coates, CEO of Mindful Money. Justine Sefton, the Deputy Chair of Impact Investing Network, Aotearoa, New Zealand. And at the end, Maria English, Chief Executive of Impact Lab. To kick off the session, I'd like to direct a question to you each. And that question is, well, what is impact for you at a personal level? Barry, I'm going to start with you, and you can use this to explain and introduce Mindful Money. But what is impact to you?
Kia ora, ngā mihi nui kia koutou. Thanks very much for inviting me, and thanks to the CFA Society for having this session. Impact for me extends beyond the financial measurements into impacts on the real world. And, I actually have qualifications as an accountant in my life and have a master's degree in finance. But very often in those disciplines you don't necessarily look at what the implications of the numbers are for real world impacts. And so for me, that's central to the sense of impact being, so what did the decisions around financing mean in terms of real world impacts, both in terms of the direct impact of the investment, but also the impact of the companies that are invested in. They're two slightly different concepts. One is directly about the investment, and the other is the companies that you invest in, whether they make an impact. So from Mindful Money's perspective, we're a charity. We provide information to the public for free on what's in portfolios. And the impact that we're trying to achieve here is informed investing. And the idea is that people realize what they're investing in, they're more likely to be investing ethically. We do annual surveys, and we've got one coincidentally being launched tomorrow morning, survey of the New Zealand public. And it shows a big rise in awareness around impact investing and a big rise in demand for impact investing. So for Mindful Money, what we're trying to do is basically increase the flow of investment to things that have an impact for a positive public purpose, environment, climate change, social equity, as being an end point of the financial transaction.
Thank you, Barry. Justine, I'm going to ask you the same question. What does impact mean to you personally? And could you please give us a brief overview of Impact Investing Network?
Thanks, John. And congratulations everyone for making it to nearly cocktail hour. If I were John, I would have got Ruby Tui on stage for this, but I'll do my best to get you there with the rest of the panel. Quickly, the Impact Investing Network, we are the peak body in New Zealand to promote the... Okay. Is that working? Okay, cool. We exist to promote the growth and diversification of impact investing in the New Zealand market and to build the ecosystem to support that. We work in collaboration with some of the other peak bodies in the sector, including Mindful Money and the Centre for Sustainable Finance and RIA, who some of you may be aware of. If you want to find out more information about us, or we'd love you to join the network, even better, please come and have a chat to me or have a look at the website. In terms of your question, John, which is a really big and interesting PhD question, are we going to talk a little bit about what making an impact means in the context of individual investments, but I wanted to sort of talk about it more at the macro level and just picking up on what Barry has touched on. And there are sort of two themes in my mind, and one is around this sort of emerging trend towards sort of dual purpose or blended investment approaches, and the other is kind of drawing a distinction between investors pursuing impact versus pursuing an impact investing strategy, which is a particular type of strategy. And as you might have heard today, I mean, we've kind of got this pretty hard and soft-wired binary approach to investing in business models around for purpose or for profit, and that's not really very helpful anymore. And investors, most if not many investors, are starting to recognise, or are recognising the relevance of climate and other ESG factors for their investments in terms of risk and opportunity, financial risk and opportunity, but that's a giant leap forward, a really positive leap forward for the industry, but not really, it's still through a risk lens, right? So I think the real paradigm shift will be when it becomes standard practice for investors to consider and manage the impact of their investments on the environment, on society, on culture, and they do that in a systematic way. They set impact-related objectives and performance metrics alongside financial return. They ideally seek to deliver positive impact through their investments or through other levers, and importantly, that there's supporting regulatory market structures that will enable that, and I think Barry's going to talk a bit about that. We're starting to see investors from different parts of the market moving towards that kind of approach. From one end of the spectrum, community trusts, other philanthropic foundations, through to the other end of big end of town with institutional investors and so on. But they're coming at it for different reasons or from different directions, but they're kind of converging in the middle. So early days, but we're moving in the right direction. The other point I wanted to talk about was around pursuing impact versus pursuing impact investing. Impact investing is a particular type of strategy, arguably where you can achieve like the deepest impact. But another way to look at impact is as a general investment factor, which you can think about in the context of all portfolios and products, and looking at it in a broader and more pragmatic sense, thinking about how you can layer different investment strategies to deliver forms of impact. And a bit just in that vein, I'm a little bit concerned that we could get really bogged down in the labels and kind of miss the big picture about getting money into good assets and projects that are aligned with a net zero or sustainable pathway, and ideally deliver positive impact. And if you can tick all the boxes to qualify for an impact investment label, which we'll talk about, that's great, but let's keep the bigger picture in mind. And I don't want to downplay the really important issue of impact washing and this increasing scrutiny of regulators around that, but I do think we kind of need to strike the right balance.
Thanks, Justine. Maria, finally, just to introduce yourself and sort of explain, I guess, what impact means to you. Justine, do apologise for the technical issues we experienced there as well, but over to you, Maria.
Thanks, John, or talofa. It's great to be here. What does impact mean to me? I think basically what it means is every person being able to live the life that they want to live, being able to form their own aspirations for their future and that of their family, and then be able to go after it. So at Impact Lab, we work with primarily NGOs and impact first investors, and we worked recently with a housing provider in Tauranga and they told us about a woman they worked with who fled an abusive situation, was living in her car for a year, heavily pregnant when she was picked up by police. They then connected her with this housing provider, and she described being in this emergency housing as the first time in a year where she had had access to a toilet from the place that she was staying. And this is in New Zealand. But she said that being in a warm, dry, safe house was like heaven. And as she looks to the future, her hopes that she described were to be reunited with her children who she'd been separated from through Oranga Tamariki, to get on a pathway to having a job and to give her kids, her tamariki, a good future. So if we think about investment, I just want to make the point, this is actually really high stakes. It's not kind of an option of do we understand whether our investment makes an impact or not, because what's at stake is, particularly for people who face the most barriers, what's at stake is investing in a way that supports their aspirations or that doesn't, and in some cases actively makes their lives a lot harder. So the question we're asking at Impact Lab is, how do we make investment work for the communities we care about so people can live the lives that they choose? And as has been mentioned, one of the big challenges with making investment work for people is we have no idea how to tell whether it's working or not. And if you compare the tools that investors have in the financial space to understand at a pretty detailed level profiles of risk and return and the leverage of funds, in the kind of social impact space, none of those tools exist. So that's the gap that we're trying to fill by drawing on a lot of large-scale government data, academic evidence, and also operational data from community and frontline organisations to build a picture of that. So yeah, I guess that's it.
Thanks, Murray. So hopefully the audience, you can see and hear that impact is different for everyone to some degree. It becomes very personal. This is arguably an extension beyond ESG preferences, or what is commonly referred to as responsible investing. I have just one slide which I'd like to share today, and that is the spectrum of capital. This is something that's been I've adopted from the CFA certificate in ESG investing. And they speak to the spectrum of capital, which is essentially a spectrum of financial return to social return. This idea of conventional investing focused solely on a financial return through to conventional investing through to philanthropy, which focuses purely on a social return. Impact investing is that in between to some degree. To help bridge, I guess, the story here, Barry, I'd like to start with what that next step is, which is responsible investing. Clearly, you're well involved in this space in the New Zealand market. Could you give me a brief overview of where we're at in terms of discussions around responsible investing today? And I'm going to combine that with a second question in the interest of time here, and try to get a sense of what are the matters that Kiwi investors focus most on.
Yeah, thanks, John. And that's a useful diagram, so it's good that it's up there. I'll kind of unpack a couple of those boxes a bit. So that area called responsible investment is often called ethical investment. The two are used pretty interchangeably. Ethical investment tends to be the words the public understands by this, whereas responsible investment or ESG investment tends to be more the financial industry's terms, but practically, they're not well defined, and generally they're used fairly interchangeably. On that responsible investment field, there's basically one area of investment, responsible investing, that says we want to avoid harm. And that's the investment that came out of the anti-slavery movement or the anti-apartheid movement. You want to avoid things which are inconsistent with your values in what you invest in. And that's really important for most New Zealanders. When we do surveys, we find, for example, 90% of New Zealanders want to avoid their money being invested in any companies that are going to violate human rights. That's the top issue for them. Up there also with human rights are issues of animal cruelty, or issues of fossil fuels, weapons, etc. But further down are social harms like tobacco and alcohol and gambling and so on. So for most of the population, that's a starting point as to what they understand about this area of ethical or responsible investing. The second area is where there's a responsibility of the investment manager to act as a responsible owner. And that's often called engagement or stewardship or active ownership, where as an owner, you're voting your shares on anything that relates to environmental and social factors, or that you're engaging directly with companies in order to try to influence them to adopt higher standards. So New Zealand's just recently formed a stewardship code, which came out of the finance sector, and that provides some principles around this area of stewardship. So both of those are broadly included within the concept of responsible investing. Then we come to the impact investing, and there's really kind of three boxes there. One box is the mainstream funds that will have a few impact investments in them. And one of the things that's happened, for example, is a number of mainstream KiwiSaver funds have started investing in bonds that have a social purpose. So, for example, Salvation Army issued some bonds for social housing in Auckland, and many KiwiSaver providers invested in those. So that's a bit of impact investing within a mainstream fund. And actually, they're generally good investments in financial terms, as well as being good for social equity. The second area is where you have the dedicated impact funds, and we don't have many of those in New Zealand. There's one or two that are available to retail investors around clean energy, electric vehicles, etc. In other countries, there's many, many more of these dedicated funds which are for social and environmental improvement. And they are going to become more popular, and the survey that we're releasing tomorrow morning says there's been a big demand for those kind of funds. And the third one borders on philanthropy, which is we accept lower returns for our impact investing. And that is a relatively small part of that investing market, but many people say, well, actually, I'd really like to invest in this. I don't need to get as high a return as commercial return. I'd be happy with a few percent rather than a full commercial rate of return. There are relatively few investors that behave like that, but that's also probably going to rise. So that's kind of the framework. What do Kiwis care about? I kind of mentioned the issues of human rights, etc. The amazing thing to me is that hasn't changed much over the past 5 years. We've done 5 annual surveys, and there is a remarkable continuation of people's concerns around the same kind of issues. And on the other side, they're asked, what are your aspirations for what you'd really like to invest in? And that's also stable. It's around healthcare, it's around clean rivers, it's around oceans, it's around renewable energy, energy efficiency, etc. And so we're seeing that these are not fads that are going to go away. Actually, they're quite strong, stable, and enduring demands from the public.
Thanks, Barry. Yeah, I think that's a good way to set the topic up. And Justine, I guess, speaking on behalf of Impact Investing Network, I know you have your own sort of formal definitions on what impact investments are. Could you please speak to that?
Yeah, thanks, John. This is working great. Okay. So impact investing, the definition of that, the high-level principles, if you like, are fairly well established now internationally, and there's local guidance on applying that in a New Zealand-specific context. And there's also, uniquely here, examples, Maori and Pacifica examples of or exemplars, you could say, of what might be described as impact investing. But in a nutshell, it's an investment made with the explicit intention to generate positive environmental, social, or cultural outcomes alongside a financial return, and importantly, the measurement of that. I'm definitely not an expert in that. And historically, impact investing has been focused on private markets, sort of early stage early stage sort of high risk entities, capital constrained markets. And but that said, in theory, impact investing can be applied across any asset class, any sector, issue, theme, geography, and across the financial return spectrum, as Barry mentioned. So that all sounds fairly simple in theory, but what we find is that applying that definition in practice is causing quite a lot of headaches for people. And sort of three main areas that we see and hear at the IIN, people struggling within the market are, firstly, how to distinguish an impact investing from another sustainable investment strategy. Second one is what qualifies, what is impact, who defines impact, what is positive impact. And thirdly, there's a hot debate over whether impact investing belongs in listed markets, and if so, how do you, what qualifies as investor contribution to impact? That's sometimes more commonly referred to as additionality, and I'll talk a little bit about that. And that's an important issue, or particularly pertinent in the New Zealand market, because as you'll all be aware, most of the funds under management here are still listed and are still allocated to listed markets. So that's an important debate. Do you want me to unpack that a little bit further, John? Have we got a few more minutes, or?
Yeah, please.
Yeah.
I think, and maybe you might be able to speak to some impacts. I know your definition online, it speaks to social, environmental and cultural impacts. Speaking to a couple of those examples, and I guess maybe expanding on that term additionality, because I think that's really important.
Yeah, sure, thanks. So impact in this context, just at a sort of general level, means a forward-looking change in environmental and social outcome that sort of directly stems from, say, a company's products and services, potentially their operations, but that's a moot point. Positive impact typically gets, people think of solutions, but there is debate over whether positive impact could also be a forward-looking reduction of harm, like a company executing on a net zero strategy, for one example. Beyond that, there's kind of no single source or arbiter of what is impact. There are frameworks that are emerging to help investors assess and compare impact investments. One common one is the IMP's 5 dimensions of impact. We're seeing taxonomies of sustainable activities. They may play a role, but ultimately, as I said, it's kind of it's not there's no single definition of what is impact, I suppose, and it can be lots of different things. It could be anything from renewable energy to sustainable agriculture, environmental regeneration, affordable housing, give access to services for marginalised communities, all sorts of things. One interesting sort of out-of-the-box impact investment that one of the local impact fund managers, Soul Capital, has in their portfolio is called, I think it's, is it Kara? No, I've forgotten the name of it now. Anyway, the name of it is, it's around providing access to content for deaf people through sign language generated by an avatar or avatar technology, and that's apparently quite powerful technology that could be applied for lots of other purposes, but as part of the sort of baked-in impact proposition of this company, they are first and foremost developing it for that beneficiary community. So that's quite an extraordinary or a deep example of impact. On the point of additionality or investor contribution, it's an important one because that's kind of what distinguishes impact investing from other strategies. And so to qualify for an impact investment label, it's not enough just to invest in a positive impact generating company or asset. You have to also demonstrate and evidence what's called investor contribution to that impact. And there's sort of 2 main ways you can do that. One, through helping to grow the company or make a project possible, or to enable it to go ahead, or to enhance the impact that is delivered, or both of those. And that could be through financial means, access to finance, flexible finance, patient capital. It could be through non-financial means, through technical assistance for refining the impact, measuring the impact, for example. And historically, the investor contribution's kind of been equated with a concept of what's financial additionality. So that's the idea that, but for that investment, the whole thing would nothing would have happened, nothing would have gone ahead, no impact would have been generated. And that kind of makes sense in highly capital constrained private market settings. But as we see impact investing moving into listed markets, that whole concept of investor contribution is really evolving, and it's proposed that an investor engaging actively around targeted impact goals with a company, and then by that I mean not just general ESG risk management engagement that Barry referred to, but actually working with a company, for example, to help them implement on agreed impact targets and KPIs, that could qualify as investor contribution, and then you get the impact investment label tick. So that's a moot point, but that's just a high-level run-through impact investing. Have a look at the IIN website.
It's a big topic we're unboxing today, of course, and I hope it's in a structured way. But the philanthropic side is really important as well. And Maria, I know you have experience measuring impact. Could you speak through, I guess, the definitions and the concepts of what you consider social value and the social return on investment?
Yeah, sure. I guess we're plugging into the yellow part to start with, but there's no reason you can't bring it up the chain. We're actually working with the South Island's largest philanthropic foundation right now to try and measure the social return on their investment with housing, to help them determine what's the discount they should give on the debt to enable these houses to be built. So once you can start to account for the social value, you can then loop it in to some of the financial kind of areas in the orange and onwards. So social value, I guess the first point is, what are you trying to make an impact on? And I guess basically there's at least two things that could be. It could be an impact on people, it could be an impact on the environment. We specialise in people because we've found people are complex enough. There's others who specialise in environment. So we're trying to measure social value for people. So if what we care about is the people, then really what we want to understand is, how does this investment meaningfully flow through into something changing in someone's life? And I really liked how Justine described that question of, well, what difference does this investment actually make? What we try to do with social value is we try to understand basically people's life pathways. So if you imagine someone kind of has a life pathway, they're going to have ups, they're going to have downs, and then at some point they're going to get access to a product, service or intervention that someone has invested in providing. And at that point, there's this opportunity to shift in a positive direction the future pathway that somebody's life takes. And I say pathway because in the social impact space, it's often not about quick wins, and you can't directly say this thing, did this for someone in the short term. We've got to really, we've found, take a lifetime perspective. And our Māori customers are challenging us to take an intergenerational perspective, which is the whole next level. So social value is really trying to value that shift, that opportunity for positive shift in someone's pathway. And that basically requires understanding three things. What was someone's pathway before they interacted with this product or service? How did they interact with the product or service? And then based on that, what can we forecast about how things could shift going forward compared to what we would expect to happen without support? And so that's where we have to draw on a lot of public data to understand, based on what we know about this person or this family, what would we expect to be happening in the general case? So for example, if we know that someone is facing addiction issues, has a physical disability and inadequate housing, if you can get them into some kind of employment training program, what's going to be the shift likely in their employment outcomes compared to what we know are typically the employment outcomes for that group of people? So I guess that's the first thing, is figuring out what are the positive outcomes we think you can achieve and the negative outcomes you can avoid through adding this service or support. And then the next step is to value that in dollar terms. And I think that's really important, because in order to understand return on investment, we need to look at the cost of this support or service and then financialise in some way the positive outcome to then have a ratio. And so that's a really challenging thing to do, and we could talk for many hours about that. But the way that we do that is basically build up what we call the impact stack. And what that means is we start at the bottom with the most easily agreed upon financial flow-on impacts of positive change. And the best one we've found to measure is avoided future government cost, because we know we have lots of data about what it costs government to do certain things, and that can link to events that we can then link to these services. So for example, if we take the example of social housing, and we actually looked at one of Salvation Army's social housing developments, we can look at, we know from research that if people get stable housing, it leads to a certain level on average of increase in school attendance. And we know we can link school attendance to an increase in high school qualification achievement. Then we can look at the fiscal cost data to say, well, if someone can go from not getting a high school qualification to getting a high school qualification, that is going to reduce their future Ministry of Social Development costs from being on welfare. It's also going to increase their family income, which we can measure through IRD. And then it's also going to actually reduce, most likely, their healthcare costs, because we can see a link in the data between education and healthcare. So the point is we can build up starting with what's the cost impact to government that's avoided because things get better. Then we can add on to that what's the likely income impact of that. And then the top of the stack is what we call subjective or intrinsic well-being, which is basically things that don't have a direct real-world monetary impact, but that we can use basically, we can use approaches to put a dollar value to that. And so we use things like the New Zealand General Social Survey to measure and value what is it worth if someone gets a 5% improvement in their general mental health. And there's very complex economisty ways of doing that. We're very careful about using those, but we think it is important to use a bit of it because often those subjective layer of impacts are the most important. So effectively, we can then stack all that up and we can say, hey, if you invest in the social housing bond with Salvation Army, we think that's going to lead to reduction in people's interaction with criminal justice and significant savings to the police, the court system, the prison system, improvements in educational attainment, which is going to lead to improvements in people's income and reduction in welfare costs, improvements in people's mental health, which we put this value on from a subjective point of view. SROI, in that case, I think it was around $2. So for every dollar you invest in this kind of capital project to develop the housing, we can see 200% return in terms of estimated lifetime long-term impact. That's probably enough for now, but we can talk more about it in the Q&A.
Thanks, Maria. Yeah, I find that really fascinating. As investment practitioners, like most of us are, we're often thinking about return and risk, but when you add a quantified impact metric to that decision-making, or to aid in decision-making, that is really quite game-changing, I feel. We have a few questions coming through from Slido. And as a reminder to the audience, please do submit your questions or upvote the ones that are there. I'm going to combine one of the questions I had with one of the questions that's come through. Barry, just speaking to the KiwiSaver space, and you mentioned before in some products there have been allocations made to impact investments. What do you consider the limitations to that? And is there a minimum time frame required when making impact investments?
Yeah, so one of the interesting things is that for most KiwiSaver funds, they have a kind of responsibility to make high financial returns, and that's typically what people are looking for when they invest in a KiwiSaver fund. But also, people are interested in ways that they can earn that high financial return and derive benefits in things that they consider to be important, real-world outcomes that they think are important. And again, one of the first things one of the first impact investments that's really happened in KiwiSaver is that example of Salvation Army social housing bond, where actually this was not a particularly risky investment because the rents from the housing were essentially government guaranteed rents. So in fact, actually you had an income stream which was very reliable and low risk. into an investment which had an adequate return. So it's not always the case that impact investment is wildly risky, although some of it is. But it depends on the stage of the investment and what kind of investment it is. So within KiwiSaver, you have basically a scheme which is long-term investment. And one of the questions that you ask is, if KiwiSaver investments are long-term, doesn't that look a bit like the New Zealand Superannuation Fund, which is also long-term? But if you look at the superannuation fund, they invest a very small, relatively small amount in market securities. So their listed securities are around 48% of the portfolio, and they're investing in other asset classes directly in infrastructure, physical assets, private equity, etc. But if you look at KiwiSaver funds, most of them invest almost all of their funds into listed equities or bonds. And so you're looking at quite different investment profiles. And one of the things that we're looking at, and Justine and I are sort of working on this Mindful Money project that is working with fund managers to say, what's the space for more investment in impact investment as part of KiwiSaver portfolios? Where are the barriers? Why can't we have an acceleration of investment in impact? Because after all, KiwiSavers as a whole is worth $90 billion. And that's a massive pool of capital that if it was applied to issues like social housing, to climate solutions, to environmental restoration, would be transformative in New Zealand, or in fact in infrastructure, and particularly climate resilient infrastructure. So you can see the promise of that happening by making KiwiSaver portfolios perhaps look a little bit more like New Zealand Superannuation Fund portfolios, because they both have long time horizons. So that's what we're trying to do with this work. And you know, the kind of, I guess, the sort of the question is also around when can you do this? How long? You mentioned how long the term it is. It really helps to have long-term investment. Otherwise, if you're an investment fund where you don't have that long-term perspective, then it is sometimes harder to invest in impact, which tends to be, as Maria talked about, much longer term in its impact and its duration. So you know, those are some of the differences. And I think, you know, in New Zealand, we have some huge opportunities to be able to take the large and increasing pools of capital in domestic capital, in KiwiSaver and retail investment in particular, and say, instead of, you know, most funds having less than 1% in anything that could be called impact, what if we can increase that? What if we can increase it to 5%, where we still serve the dual aims of financial returns, but also we look for real-world impact out of that, and we do it in an authentic way, not via greenwash? Then I think that would really be transformative for the New Zealand economy, as well as contributing globally.
Thanks, Barry. Maria, I'm going to jump back to you, actually, because social housing has been mentioned quite a few times, and I think it's an interesting use case to apply how you can, I guess, assess impact relative to different forms of funding. So, for example, this is a difficult question, but if you were to, say, assess the impact from a social housing project where capital is invested, homes are built and rented out, relative to, say, rent subsidies to low-income households, how would you go about weighing up those impacts between those two activities? Yeah. One being an investment, one being a grant.
Yeah, and I think a lot of funders at the philanthropic end are asking this exact question right now. So I guess we kind of look at both sides of it, which is social value and then investment, or like financial cost. So on the social value side, we basically ask the same question of both options, which is who's in the housing, what changes in their lives as a result, what's the scale at which people, how many people are in the houses and how much are they engaging with it, and therefore what could we expect that long-term social value to be. So immediately you get a really interesting question, which is it the same kinds of people or families in the grant version versus the investment version? And almost always we find the answer is no. So almost always when investors think they're doing the same thing in 3 different places, we've looked at 250 interventions, over 230 mil of investment so far, and there's always differences when you actually look at the data. So who, and then what's the nature of the support they're getting. So that will tell you on the social value side whether the return from a value perspective is similar or different. Let's assume that it turns out it's the same house and it's the same families. Then you turn to the investment side, which is to say, how is the cost flowing and what's the leverage you're getting on your funds? And that's where we're starting to build out some interesting modelling for SROI on housing particularly, because obviously a clear attraction of investing versus granting is A, you can get that money back and put it in again, and B, you get the whole value of the lifetime of the asset you're investing in versus the one-off kind of annual or whatever it is grant to that family. So I think we're still getting into it. We're working with about 20 different housing providers at the moment, and I think what we're actually going to see is there's quite a range on social value side, because we're going to find there's actually all these, like, if you're housing a significantly disabled single man versus a Pacific family of 15, you're just going to see different value profiles. But I think where we're really going to see differences is once you look at the leverage on funds. And naturally, I think you gravitate then to investment versus granting models. But we'll find out. We'll come back and let you know.
There's a lot of questions coming through that relate to, I guess, the bridge between responsible investing and impact investing. Some questions with regards to is an exclusionary approach to listed investments, does that make an impact? Can you make an impact in listed securities? Justine, I'm going to ask you this question to you if you don't mind, because I think it touches on some of the definitions that you mentioned before, and you did say a bulk of funds in New Zealand are more in the listed space. For this part of the market to evolve, well, firstly, answering those questions, do you think there's a difference between listed assets and unlisted assets in terms of what impact can be achieved?
Thanks, John. No, it's a good question, and I'd invite Barry and Maria if you want to jump in as well. But I think, I mean, the main thing about impact investing, or the distinguishing feature is, well, the 2 distinguishing features. One is that it's about generating positive impact, and 2, the investor has to contribute in some appropriate way or eligible way towards the generation of that impact. So with responsible investment strategies, or what have, the first generation of those, you could say the focus was on harm, avoiding harm, not generating positive impact, and it was pretty much an exclusions-based approach. With an impact investment, you still think about exclusions, but your first objective is, what's the problem we're trying to solve, and how can we, what's the problem we're trying to solve? What's our business model for that? And is it actually going to, does it actually solve the problem, and does it actually serve the target beneficiaries? Because a lot of time should get spent on that. But at the same time, you obviously don't look at investments which would be on, your exclusions list, or fundamentally misaligned with the positive impact that generate harm, that are misaligned with what you're trying to achieve from impact terms, but also you'd apply a kind of a do no significant harm overlay across that as well. The difference from other types of sustainable investment strategies, as I mentioned before, is that it's great to, first of all, you make sure that the company or the asset you're investing in generates positive impact in a meaningful way, but then you need to show that you're helping in some ways. As I said, like either your financing is helping that company to scale, or you're working with that company to generate better impact or do it in a different way. An example of that might be you get well-intended funds or philanthropists going into developing countries to build schools.
thinking that's a great thing, but they end up with buildings that are empty and become derelict because they haven't factored in that there's a shortage of teachers, and that could be because it's a remote location, or there's no access to affordable housing or something like that. So those are the main differences. In terms of the deepest impact, I think it's still probably fair to say that the deepest impact generally can be achieved in private markets. That's when you're helping early stage ventures actually get off the ground and scale and deliver their products and services which are making real change in people's lives or, in the environment. But there is a view that, actually there are two views on this. One is that you need to look at impact investing as a sort of broad ecosystem. So there is a role for listed markets to play complementing private markets, providing a responsible exit from those private market impact investments into listed markets. In some cases, you may help those in listed markets, there could be further capital raise, but more likely the impact from the investor is going to be a much stronger stewardship or partnership approach, really, holding those investee companies accountable to delivering the impact that they promised.
Yeah, thank you, Justine. Look, on that note, we're out of time. We've had the red light flashing here for at least a minute now. Please join me in thanking our panellists today. I hope you can all take away, I guess, what is bridging of knowledge here between those different disciplines of responsible investing, philanthropy, and impact investing. Thank you.